Hello guys and welcome back to another portfolio update where I go through my £50,000 plus stocks and shares ISA portfolio I hold on Trading 212. This one being a bit different from normal with a brand new house with lots of moving stuff in the background and of course a new milestone which is pretty big at £50,000 invested in stocks and shares. I invest in just 8 companies that are monopolies or have a particular competitive advantage in their field, with a focus on years of positive free cash flow that is expected to grow into the future. I'll cover the overall return of this portfolio in more recent times, then jump into my buys and sells that I've been making this month. I'm recently completely sold out of one position and added to another one of my holdings substantially. And then we'll be going through each position, their weighting and overall returns that they've been producing in more recent times. Finally, at the end, I'm probably going to talk about how I'm trying to grow this portfolio well into the future. Now that I've hit that new milestone of £50,000, I'm well on my way to making that a possibility and I want to keep up the pressure. If you like this sort of content though and feel like you get something out of it, then please feel free to consider giving the video a like and maybe consider subscribing to the channel to not miss out on anything. So firstly, just to talk about the change in scenery and background. Obviously, there's lots going on in my life. I've recently moved homes, and this is, despite my old and rather grainy camera, is my new way of recording. So hopefully this is going to improve as time goes on and I mess about with the camera settings, get myself a new camera maybe for Christmas, and maybe talk about this whole new place. So basically, I've moved out of my old home, gone to this home, and I'm hoping to maybe use that in the future in my investing journey. So I won't give anything away about maybe what's happening, but it could maybe increase my income into the future. But don't worry, I have been paying close attention to my holdings and been making some trades that I think you might like to see. Now, my overall value for this portfolio has broke through a new milestone, a very big one indeed, hitting over £50,000. We have about £51,000 overall value of the portfolio right now. Now, a lot of that has come from invested capital. Over £40,000 or so has been from the money we have put in. And then we have an unrealised gain of about £10,000 or around 25%, which is all nice round numbers. But actually, the time-weighted return is a little higher. If we take a look at it on a time-weighted return basis over the past year, we've actually sold out of a number of positions for quite a bit of a gain. About £1,444 were made from positions of being sold. And then we have about £250 that we've received through dividends that we have then reinvested back into this account or held in cash. And then we've got an interest rate on our cash that has made us about £50. All that added up together makes us over that £12,000 made for a time-weighted return, or around closer to about 28 to 29%. So that's our full overall return, and that's actually outperformed in the last 6 months, with this portfolio up about 26% compared to the S&P 500, which is up closer to 11 to 12%. Now, that's not really to basically brag, that's just to say that I've done well over the past 6 months, as a lot of people have, and obviously this is reflected of that. Now let's talk through my buys and sells. Obviously we've sold out of a position completely, making our 9 investments go down to 8 in more recent times, if you're familiar with the channel. And that was one I actually alluded to in my last video and something I wanted to enact for a couple of months now. And that is actually selling out of my entire position in my only real estate trust, which was Vici Properties. I had around 80 shares of Vici left, valued at just over £2,000, around about £1,974. And after trimming the position last month, and I sort of decided there was a good opportunity in my portfolio with a company that I wanted more exposure to. So I bit the bullet and sold Vici at a cost per share of around $31.54. Which was actually about a realised gain of £116 or just around 6%. Now, this isn't the most lucrative of trades, you can obviously argue. Over that space of time, with dividends received, I've probably returned about 11% from Vici, which I don't think is that bad, but with the market up that much, it isn't the best. But I would say I've exited this position for the right reasons, according to myself. And that was two main reasons. Firstly, I saw another position that I wanted to add to more. I believe in this company, maybe a little bit more than Vici, and just saw a good opportunity and entrance point for this point in the portfolio. As well as that, I actually think my original thesis for investing in Vici was a little bit flawed. My research into the company, that is. One of the main things that has always left a sour taste in my mouth is the dilution of shares through a real estate trust. Now, this isn't just aimed at Vici. They're an amazing company. They're a very predictive business model, and they have a very high dividend yield. And if that is your focus, then that is definitely a great company to be invested in. But for me, I actually want to focus on compounding my share count over the years. I want my shares individually to become more and more valuable. And the best way to do this is through share buybacks and at least not diluting shareholders' position, which unfortunately real estate trusts do quite a bit of. Just leverage money is how they operate. So I didn't really feel comfortable having that in my portfolio anymore. I want to go maybe a different direction. So I sold the position and actually bought more of Google. I bought around 14 more shares of Google at a share count of about $175 per share. So that's around about £1,974 that I've now added in value to my Google investment. And I've now got a portfolio weighting of around 10% for Google and an overall share count and value of around about £5,000, which is very nice to see. That being said, let's now talk about my individual positions and how they're performing year to date. So obviously we have Amazon, which I have 74 shares of, and its overall value is now sitting over £13,500. We're up by about £3,100 on the position, or around just over 30%. And we can see my cost per share is averaged at about $176 per share, which I thought was a very good starting point for Amazon. As we can see here, year to date, it's up by about 54%, and I thought at this sort of point, around definitely below the $170 mark when I was buying in, I thought this was an amazing entry point for Amazon. They were trading at their lowest 10-year low of price to operating free cash flow, and I just thought that was an amazing opportunity. They're an amazing business, they're fast growing in lots of different areas, leader in cloud. There's just lots of good things about Amazon, and I'm so glad that my weighting is so high. If we take a look at my weighting, it sits at about 26% in the overall portfolio, which I'm very happy with. As I said, it's the number one in cloud service, number two in streaming service, number one in e-commerce in the whole world. And it's obviously got faster growing areas of other business like advertisement and stuff like that. So every time I look at how this company is growing, I see lots of avenues of growth in high margined areas, and their e-commerce side of the business, which is obviously low margined, is becoming less and less part of their revenue streams, which I think is really promising for this company. Next, in terms of weighting, we have my Visa position. I have 34 shares, an overall value of £8,500. We're up by about £1,400 in the position, or around 19 to 20%. This is a exceedingly good position for me, just in terms of dividend growth and just in terms of scalability of business model. I love the predictability of Visa and MasterCard. I think they're effectively running an oligopoly, and that is one of the best places to invest your money because it's so predictable. Devkant Casario, he talks about the predictable nature of these financial companies and how amazing it is to maybe invest in them because you can see the predictability over time of that share price, the intrinsic value going up. So I really like investing in this one. I would love to grab MasterCard as well. My cost per share is around about $263 per share, and it's now set at $317 per share. Over the past month, it's traded pretty much flat. Over the 3 months, it's actually up by about 10%. So it's actually gained a lot in more recent times. Weighting actually now takes up about 16% of the overall portfolio. Now I'm fine with that. Over time I hope to get another sort of exposure to MasterCard and maybe build out my exposure to others, so this may go down, but I'm hoping to keep it at over 10%. So then we have my third largest holding, which of course is Brookfield Corporation, one I've tried to pad out in more recent times. I've got around 168 shares valued over £7,800 now, and we're up by about 20% on the position, or around £1,300. We can see that my average share price is $49.50 after we've been buying more into this company. We were originally buying around the $46 to $44 mark, and obviously since then it's gone up massively. I really wish I was adding more to this position back then, because I would have been able to pad it out. Terms its weighting, it's just over 15% now, and I'd actually like to get this up to about 20% into the future. In terms of reasons why, I think it's massively predictable. They can demonstrate massive value to shareholders through capital allocation and just an amazing management team. The likes of Bruce Flack and stuff like that. So when I look at this business, even though I think people tend to fall into the category of not wanting to touch this one at all because it's too complicated and a bit of a black box, and the sort of income reports and stuff are very hard to understand and maybe are not for everyone, I do think that this business, I definitely fall on the other side, which is I just love the way that they allocate capital and invest in companies, and then when those companies are done growing, use the free cash flow that they continue to produce to reallocate back into other areas of business that they've just bought into and produce free cash flow all over again. So it just keeps on turning, and I think this business has grown massively because of this management team and their capital allocation. There's a massive insider share count as well, so that gives me lots of hopes that they're not going to dilute my shareholder position into the future. My fourth largest holding, we have Salesforce. Now this was one that was my third largest holding, but I actually trimmed this position just last month, going from 30 shares now down to 20. I have an overall value of just over £5,500 to £5,600, and it's up around about £1,650, or around 41 to 42%. And you can see here over the past year, Salesforce has done quite well, up 35%. But that wasn't always the case. When I was buying in June and May time, it was well below that. And I just thought it was massively undervalued. People were talking about this one being beat out as behind the curve with AI and going to be beat out by competition, and it's not ever going to be true. But that was what the market consensus was, and the share count was just down so much that I just thought this was an amazing opportunity. And since that time, it's massively spiked up. I actually sold around about $361, which is weird because obviously that looks really like I've timed it well. I normally don't, I promise. But yeah, in general, I thought that it wasn't trading, it still isn't trading at massively high valuations. I just thought I could use that money elsewhere. So I actually channeled that money into Brookfield last time. But I still have massive hopes for Salesforce. I've not sold out of my position entirely. I've just trimmed it a little bit. And generally, my main reason to continue to invest in Salesforce is because this business I could see doing really well in this sort of AI wave that we've now got on ourselves. I know that sounds really like black boxy, but generally, Salesforce is an amazing company because now they're talking about the particular agents. And this just is essentially sort of automated tasks, but on a whole nother level with Salesforce. And I think if anyone can monetize and make this work for their subscription-based model, it is Salesforce. So their sticky products are just amazing. I think lots of companies do very well out of this business, and that then means that they were more likely to use a higher package that involves these new agents that may cut down on the amount of man hours and stuff like that they have to use for monotonous tasks if they can use these agents, as Salesforce are now talking about. I'm not a massive fan of the management team. Mark Benioff is a bit of an acquired taste that I don't think is quite there for me. But I do really want to stay invested in this company, and I have massive aspirations for it into the future. As you can see here, its overall weighting is now, oh my god, it's now my fifth hardest holding, is now 10.99 because Google has overtaken it, which brings us on to the next one. So now my fourth largest holding being Google, which now has 37 shares after we bought into it quite recently, around about 2 weeks or so ago. We have £5,782 and it's now up by about £920 or 18.92%. And we was actually buying on this dip here. I actually bought right at the bottom of this dip and have averaged in as this gone up a little bit. Obviously, it's now done massively well over the past month, being up around 10%. And our cost per share is now sitting at $167 per share, which I don't think is too bad for Google. Now, one of the main things for reasons why to invest in this company was the cloud business and other things like that. I just don't see any realistic chance that this company is going to be broken up. I think it would hurt America quite a bit. I don't think that helps their foreign policy at all. They want to maintain their dominance in search from an American standpoint. So I don't see that happening, especially under Donald Trump's sort of leadership. So into the future, I'm sure, as it's starting to look now, people are pricing in a different approach. Mainly due to this new chip announcement that they've made, people are getting very excited and they think this is going to be the next massive thing. It may be, but from my understanding of it, it is something that was produced in a very isolated sort of environment. And I don't want to get into too much of it, but I do think that Google has a long way to go before they can use this particular chip to maybe mass produce it and sell it as the likes of NVIDIA have done. But it is an innovative company, and the likes of Waymo and this new chip give me lots of hopes for new revenue streams into the future. And of course, its weighting is now above Salesforce by to now 11.34%, which I find quite funny because Salesforce was considerably ahead of it just a couple of weeks ago. So you can never really predict what's going to happen in the market. Next, in terms of weighting, we have my Melly position. I have 3 shares in this company, now valued at over £4,200, up by about £300 or around 7.7%. And I actually think now would be a good time to maybe buy into Melly. I think its free cash flow yield right now would be a bit skewered because of their fintech business, but actually looks very good. They're fast growing, probably the fastest in all of my companies in this portfolio. Even though they trade in markets that I don't think are necessarily that predictable, which is maybe part of the reason they trade this sort of valuation, in more recent times they've come down quite a bit. They're down about 6 to 7% this month, and over the past 3 months down 15%. And I think that's mainly because people are getting very excited about America and maybe China, and they're sort of forgetting about this amazing company that is just sitting on the sidelines. The e-commerce giant like this is just going to develop massively and is maybe about 10 to 20 years behind what the likes Amazon was. So whilst I don't know necessarily if it's going to go that way, I do have massive hopes for Melly because of how quickly they're producing their revenue streams, their amazingly fast growing fintech business, which is higher margined than their e-commerce side of the business. And it's just an amazing company that I wanted exposure to. Its weighting now makes up around about 8.3% of the overall portfolio, and I'm fine with that. I want to keep it below 10%. As time goes on, I can see this one maybe becoming less part of the portfolio as I focus on more predictability, but I do think Melly has that. Just because it operates in these countries does not mean it doesn't. And at the moment, I don't think that's necessarily being priced in by the investors right now. And one of my second to smallest position is S&P Global. We have 7 shares, just over £2,800 now, up by about 18 to 19% or around £446. This position that I actually was buying into, obviously on this dip here, I thought it presented a very good opportunity in a very predictable business model that is an effective, I wouldn't say, it's not an oligopoly, isn't it? Because there's 3. So I would say that S&P Global, Fitch and Moody's all present great businesses that effectively are indispensable within American society. Their ratings business on debt is just very hard to shake. They are a very useful company and they just have to be paid by big corporations. I think there's a very famous sort of interview with Warren Buffett saying he doesn't want to pay Moody's, which is the other counterpart to S&P Global, but he has no choice, and that is an amazing business model. So even Warren Buffett thinks this is an amazing company, and I think they are too. They've got a fast-growing dividend, as well as producing predictable and fast-growing free cash flow. And my average share price is around $419 per share, and it now makes up a weighting of around about 5.49%, which is pretty a shame for such an amazing company like S&P Global. Over the past 3 months, it's traded relatively flat, and for the year, it's up by about 16%. I've held this one quite a long time, but in general, I actually quite like it, and I would love to add to the position as well because of how predictable it is. I know DevCount Desario has been adding to it. I don't really want to add at these sort of levels. I prefer it to come a little bit down, but I am keeping an eye on it, and I probably will add to this company into the future. And finally, my smallest position now, which is Texas Roadhouse. So I've 18 shares at a value of over £2,700, up by about £990 or up by about 57%. And this is a position that I was buying into around over a year now ago, in October 2023, when it was below $100. I actually sold it in my taxable account and then bought back in around the $118 mark, and that is obviously where my share count now sits. I've held on to the company because I think this is an amazing mid-cap now, I think it is, that is just producing amazing returns. When I was buying in, everyone was talking about how this company wasn't necessarily going to survive. They've continued to open up restaurants, continued to offer up amazing service, and that has been rewarded through share price. So whilst I don't think they trade at a massively great valuation right now, it is getting better with time. So I'm continuing to hold this one for the long term. It's an exposure to an industry that I really want to be involved in, and I do think it has amazing growth potential within the United States. Once we get onto international grounds, I do think there may be slight hold-ups on this name of Texas, but I do think that this company has a massive runway and predictable runway for growth in America. And now its weighting currently sits at just over around about 5.3%. And it is a business that I do think that will stay at that sort of level, probably drop below that 5% in the future. So there we go, that is all of my positions pretty much. All of these companies I believe have a competitive advantage or monopoly. That's why I invest in them. Now, my main reason to invest in Amazon predominantly is obvious, because they're the leader in lots of different areas that are becoming more higher margined and more predictable. In terms of the best companies to maybe invest in now, obviously I was buying into Google when I thought it was still undervalued. It now offers, I think it's getting towards over fair value in my opinion. Just with their stock-based compensation, I think there's a lot of being priced into the stock into the future. And people tend to like companies and dive in right now, but that may not always be the case. So I think that could potentially be a good opportunity to buy in to Google into the future. In terms of the best sort of opportunities now in this portfolio, I think Melly's offering a good opportunity and a good entry point. I just don't really want to add to Melly again really, but I may have no choice. I still have around about £1,700 in sort of free funds that's getting about a 4.9% interest. And I have money that's outside of this account because obviously I will hopefully be transferring money in on April in 2025. So that's my only free funds in this time span. Other than that, I really don't think that there's many companies that are trading for very good valuations right now. The market is really overvalued. Brookfield, I still think, offers a good yield right now. I do think that's my own maybe judgment, and people maybe not agree. But in terms of just its overall perspective in this portfolio, I do think it's actually looking quite good right now, but I could see the market actually dropping over the next 6 to 12 months because I don't think that these sort of levels can continue. I do think that lots being priced in with individual companies. You see in Palantir go through the roof on 60 times sales. We're seeing costs go up to about 60 PE. I think there's lots of businesses that are trading at very extortionate valuations right now. Not because they don't necessarily justify it. It's not because they're amazing businesses. It's just because people are trying to own them all now. And I think that people diving in is a bit of a worrying time to be an investor. So whilst I like seeing all of my positions up, it actually makes me worried because I can't add to any of my positions and lower my share cost per share. And generally, I don't want to at these sorts of levels. So I'm just holding money at the moment, waiting to see what happens with the market and building out my cash position. Obviously, I'm not trying to time the market. If individual companies like Mercado Libre come down to my share price, which it's starting to look like it might do, then I will actually add to these positions. But I would like to do so on my own terms and not when I'm just fear of missing out and jumping into companies. But that is my companies, guys, and that is my portfolio. Feel free to let me know down below what you think of these businesses. Is there any you'd buy now and the reasons why? I'd love to hear it and maybe have a conversation with you guys. But thanks for watching. I do appreciate it, and I'll catch you in the next one.